Guys, and welcome to another series of videos by Geeked on Managerial Accounting. Today I'm going to be talking about a big one, Chapter 11, Variance Analysis. Now, in this chapter, this is essentially where all of my peers and myself really got stuck on during the course. And even though the concepts and the techniques in this chapter are very simple and straightforward, it's just that it can throw you off the way that the textbook does it. So the way that I'm going to show you is more logical because you know exactly what's going on rather than memorizing a couple of formulas. So the four main things that I'm gonna do in my videos are direct material price and volume variance, direct labor price and volume variance, variable overhead spending and efficiency variance, and fixed overhead spending and efficiency variance. Now all of that may seem like terminology overload, but actually all of this is very simple, and I'm going to show you how to apply these techniques in a question, which I have on the next page. So, Bill's Toys makes packages of different toys for toddlers. The following is the budgeted or standard information for June. So, direct material is $2 per, that should be package. Apologies, that should be, I'll just fix it. $2 per package, and the quantity standard is 15 parts per package. And then direct labor is $10 per hour, and direct labor quantity is 2 hours per package. Variable overhead is estimated at $5 per package. Fixed overhead is estimated at $24,000 per month. The rest of the information is irrelevant right now. So following is what actually happened. Production 2,400, sales 1,600, direct material purchase is 30,000, cost of parts 62,000, and the list goes on. I made this list, so I'm not going to go over it again, but I will be showing you what all of this means and where it goes when I'm doing the question. So let's get started. So in order for me to do the first part, which is direct material price and volume variance, just a second. So in order to do direct material price and volume variance, this is what I'm going to do. First off, I'm going to start off with the heading direct material, and then I'm going to draw two arrows, and I'm going to name each of these price and volume, right? So it's essentially what I'm trying to do here for direct material price variance analysis. I want to compare my standard price to my actual price in order to see the difference, if there is any, and to make decisions such as is my current supplier a good person to deal with? So if my actual price is less than what I thought it would be at the start of the month, that's a good sign, right? So I should continue with this guy, and vice versa if it's the other way around, right? So in order to do that, I would further divide each of these into standard and actual, right? And I would do the same thing for volume. Standard, actual. Okay, then we're going to start off with price variance. So when it comes to direct material price variance analysis, the variable that changes is your price. So I want to compare my standard price to my actual price. But in order for me to do that, I would multiply my price by the total number of packages in this case to arrive at a total, and then compare those totals, right? So that total stays the same between the standard and the actual. For direct material, the total is always your actual, so actual material purchased. It's always actual material purchased multiplied by my standard and my actual price. Let me show you what that means. So I'm going to take my standard price, which is $2 per package, and I'm going to multiply it by what I actually purchased. So direct material purchases are 30,000 parts. So I'm going to do 30,000 times $2. That comes out to 60,000. That is my standard. I want to compare it to my actual now. What's the cost of my direct materials that I actually paid out? So I would do the same thing. I would multiply 30,000 by my actual price, but I don't need to do that in this question because it's already calculated for me. Cost of parts 62,000. So I'm just going to copy that here. And now I want to compare these two figures. Is this scenario favorable or unfavorable? Well, it's unfavorable because what I actually paid is greater than what I thought I would pay. So this is like $2,000 unfavorable. All right, that is it. Moving on to volume. It follows almost the same procedure, but uh, I'll show you why it's a bit different. So again, as we were doing price, price is the variable that changed between standard and actual. Over here, volume is going to be the variable that changes between standard and actual. So in order for me to find my volume, what I do is this. I see what my production, my actual production is. So in this case, my actual production is 2,400 packages. So let me just copy that here, 2,400 packages. In order for me to find my standard volume, I would see how much direct material I would need in order for me to create or manufacture 2,400 packages. So my budgeted quantity standard is 15 parts per package, right? That's what I thought it would be at the start of the month. So what I'm going to do is I'm going to multiply 2,400, which is my actual number of units, times what I thought I would have, the number of parts I thought I would have to put into that many packages. So that comes out to 2,400 times 15, that's 36,000. Mind you, this is only parts. This is not in dollars because we're currently trying to calculate how many parts would go into 2,400 packages of toys. And that is your standard, really. That is what we thought would go into 2,400 packages. To find my actual, I'm simply going to multiply my actual units times what actually happened. So in this case, again, I don't have to find that information. It's already given to me. Direct material used is 34,000 parts. So I'm just going to copy that here, 34,000 parts. Again, the question is this situation favorable or unfavorable? Well, it's favorable now because your actual number of parts is less than your standard number of parts. So you had to use 2,000 less parts in order to create or manufacture 2,400 packages. So this is 24,000 parts favorable. But I need to arrive at a dollar value. Always remember that variance analysis is done in dollars. So in order for me to do that, I will multiply this by my standard price. That is just procedure. You always have to multiply it by your standard price. So $2 per package, I multiply by 2. It comes out to $4,000 favorable. And that is it. All right. That is it for direct material price and volume variance. Now that we're done with the first part, we're going to move on to the second part. This is done. Let's put a big check there. So direct labor, price, and volume variance. And we're going to do exactly that. So again, same procedure. Heading, direct labor. 2 arrows, price, and volume. Further subdivide into standard and actual. And draw a line here. Standard, actual. All right. So again, we're going to start off with price, and the variable that changes is price. So I'm going to take my standard direct labor price, which is 10 per hour, and multiply it by my actual direct labor hours, sorry. So that's 4,200 hours. So 10 times 4,200. So 4,200 times 10, that's $42,000. That's my standard price for direct labor. When it comes to actual, again, it's going to be given to me somewhere. Yeah, so over there, direct labor cost 39,000 hours. Again, if this information wasn't given to me, all right, this is in dollars. If this information was given to me directly, I would take whatever price was given to me. So my actual price times my so it would be my actual price times what? My actual labor hours. Sorry, just yeah. So in this case, since it is given to me, I'm just going to copy it down here, 39,000, and then I'm going to compare the two. So 42 and 39, that's $3,000 difference. But is it favorable or unfavorable? Well, it's favorable in this case because my actual is less than my standard. So I'm actually spending less than what I thought I would. So that's $3,000 favorable. Excellent. Moving on to volume. Same procedure. Volume changes. That's a variable that changes, but that volume is based on the actual level of activity, which is 2,400 packages. Let's move back. So my budgeted or my standard rate was that I would be spending 2 hours per package, right? So in order for me to manufacture 2,400 packages, it would take me 4,200 hours, right? That's my standard. So 2,400 times 2 hours, that's 4,800 hours. But what I actually spent making those parts is direct labor is 4,200 hours, right? So I'm just gonna copy it here. 4,200 hours is what I actually spent on those packages. So 4,200 hours and 4,800 hours, compare the two. My actual, since it is less than my standard, that is a favorable situation. So that's 600 hours favorable. And then again, I need it in dollar terms, so I'm going to multiply by my standard times standard price, which is 10, and that comes out to $6,000 favorable. All right, now in order for me to find the total direct material variance, this is another thing that I haven't written over here. In order for me to find the total direct material variance, you're not really going to be tested on this, but it's good to know. So I want to know what my total direct material variance is. So I'm going to take the comparison of these two, and in this case, I'm going to see, like, think of $2,000 unfavorable as minus 2,000, and think of 4,000 favorable as plus 4,000, because 4,000 favorable is like in your favor, so that's a good thing. But $2,000 unfavorable is like negative, sort of. So negative 2,000 plus 4,000, that's $2,000 favorable overall. That's for your total DM variance analysis. The same thing for direct labor. I'm going to compare these two. So that's $3,000 favorable plus, think of it as plus 3,000, and $6,000 favorable plus 6,000. Add the two up together, that's $9,000 favorable. Excellent. So overall, both turn out to be favorable, and that's a good sign because your current supplier is like a good guy. He's giving you a good deal. All right, so we're left with parts 3 and 4, which I'm going to cover in my next video. So stay tuned, guys, because the question isn't over.